Hello students, in this video we are going to see Markov process for accounts receivable analysis. Before we start understanding that, first let us understand a particular method called total balance method in account receivable analysis. Uh, Although this particular example uses account receivable analysis, similar applications can be used in some other fields, which I will also explain during the example. Right. So let us consider a situation, a account receivable situation for Hidman departmental store. Hidman uses two aging categories for the account receivable. So as we know that uh, we generate account receivables when we have already given the material to a particular third party or our one of the customer, and we are still waiting for the money to be paid, because we normally give credit period. It can be 15 days, 30 days, etc. So that is called as account receivable. So this particular company has two aging categories: accounts that are classified as 0 to 30 days old, and secondly accounts that are classified as 31 to 90 days old. Right. If any portion of the account balance exceed 90 days, which is very important, it will be written off as bad debt. Right, it will be written off as bad debt, whatever is taken. So obviously one need to understand that the onus of accounts receivable is not on accounts department. The onus of the recovery of account receivable is usually on the field force or the sales force only, because they are the one who are in touch with the customers, and they are the one who have sold that material to the customer, so they are supposed to get the money from the customers. So so basically the sales team, the field team has to continuously work on reducing the account receivables. So suppose there are three different bills, right? So first there is a date of purchase on August 15, which is $25, and so it will be categorized as 31 to 90 days, because it is around, right now it is September 2030, today's date. Assume today's date as September 30, then August 15 transaction will be 40 days plus old, so it will be categorized as 31 to 90 days. The other two transactions, the $10 and $50, which are happened few days before, so they will be categorized as 0 to 30 days. So the total $85 will be categorized as the, clearly mentioned here, the oldest unpaid bill, because the oldest unpaid bill is of August 15. The entire amount of $85 will be shown in as account receivable of 31 to 90 days category. Right. So that is how the process will pressurize the sales team to convert this 31 to 90 days to 0 to 30 days. How to convert them? Basically the sales people must must convince the customer that at least you pay this August 15 wala bill quickly. So suppose the customer pays the August 15 bill of $25, then the remaining will be $60. Now that $60 will be get reclassified as 0 to 30 days. So this is how the total balance method works, and that is what we need to understand. Right. If the bill goes beyond 90 days, then it will become a bad debt. Once it becomes a bad debt, even if it is recovered after 90 days or 91st days, 94th day, it will be still shown as bad debt in the system, and that recovery will be shown as some other bills received. Right. So In this situation right now, suppose, let us assume that, so we start here, our example starts here. Let us assume that on 31st December, current balance of this account receivable is $3,000 in the account receivable, and out of which this $3,000, uh, they are basically either in 0 to 30 days category or 31 to 90 days category. Right now I think they have given in ahead that, let me just check that, I'll just explain this right now only. Yes, so right now they have $1,000 as 0 to 30 days category. This left side shows the 0 to 30 days category, and $2,000 are in. So the whole thing is given here, that this is how the current status is, right? So that is what the current status is, right? And what is the requirement? So because this is the current status, we want to find out, the accounts department is interested in finding out how much of this $3,000 will be finally recovered and how much of this will become bad debts. Because if it is becoming bad debts, that particular amount accounts department has to provide for, right? Here the accounting period is ending and on 31st, that's why we are seeing, but in India it will be 31st March. So because they want to provide for that bad debts, they want to get an estimate of what will be the bad debt out of this $3,000. So for that, there is again a transition matrix which is given to us, which will be there in the organizations based on their earlier experience. So there are 4 states. First state is paid category. When the bill is paid, it will become paid category. If the bill becomes 90 days and old, more than 90 days, it becomes bad debt category. 0 to 30 days is the state 3, and state 4 is 31 to 90 days. The first 2 categories, S1 and S2, we will call it this as S1, S2, S3, S4. These are called as absorbing categories, because once the accounts reaches there, right, it cannot be changed, right? Absorbing categories. Whereas the other 2 categories will be called as transition categories, because from here the accounts can become bad debt or become paid or become interchange between from 0 to 30 days, it can become 31 to days. So these are called as transition states, right? Right. So transition states. So these 4 states and their transitions are shown in the transition matrix which is given to us. So this is your transition matrix. So right now, if you see here, this first row and first column belong to the state 1, that is your paid category. The second row and second column belongs to the bad debt category, right? So that is why if you observe this first, once it becomes paid, it cannot move to other category. That is why the probability is 0, right? Once it is paid category, it will remain as paid category. That is why it is 1 year and 0 here. Once it becomes a bad debt category, it will remain as bad debt category, as I told you, and it cannot change to other. So that is why these 2 are absorbing categories. 1, 0 and 0, 1 clearly shows this. Whereas S3 is 0 to 30 days and S4 is 31 to 40 days. So you can see that from 0 to 30 days, it cannot directly become a bad debt, right? From 0 to 30 days, it will become 31 to 90 days first. That is why 0 to 30 days cannot directly become bad debt. That is why 0 here, and there is a 40% chance that 0 to 30 will be recovered fully. From the 31 to 90 days also there is 40% chance, and remaining probabilities are given here. So this is the given information. Now how to solve this? There is a step-by-step process which I have also given you here in a document here separately. So we'll understand this, and this document can be also used for your reference. So as I have already mentioned to you that S1 and S2 are absorbing states, and the remaining are fluid state or the transition state. Now we are going to follow 7-step procedure. This is a bigger problem for Markov, and sometimes it can be also used as a compulsory question, so usually 20 marks, and hence you need to follow the steps properly. So this is the starting point. This matrix will be given to you. First step is to convert this matrix into 4 small matrix. So simply just divide it in the middle and it will get converted into 4 small matrix. This particular matrix is called as identity matrix, and this is your null matrix, right? Null matrix 0, right? This is 1 0 0 1 is our identity matrix. This bottom matrix is called as R matrix, and this right side matrix is called as the Q matrix. So now this is the first step. So we have divided it into 4 matrix. R and Q we are going to work on. So I will write R and Q separately. 0.4, 0.0 and 0.42 is R, and Q is 0.3, 0.3, 0.3, 0.1 Q. So R and Q is done. Now we are going to calculate, the next step is I minus Q. If you look at my the other step by steps, compute, we have done this 4 matrices, then compute I minus Q. So I is the unity matrix, minus Q is this matrix. So unity matrix, and you know how to do the subtraction. If it is I minus Q, so suppose this is your I here. I'll just use this space to show you I 1 0 0 1. This is my I matrix. Right, this is my I matrix minus this Q matrix, which is this 0.3, right, 0.3, 0.3, 0.1, right. Simply you are going to do minus 1 minus 0.3, it will be 0.7. See here, your answer is given here. This is the answer, right? So simply multiply minus 1 minus 0.3, 0 minus 0.3, corresponding items will be just subtracted, and you will get this I minus Q. Once you get this I minus Q, we are going to find the inverse of it. The process for the inverse is mentioned in appendix 16.1. So let me quickly go to this appendix 16.1. Right now we are on 803 page. So I will take you this appendix 16.1 to just show you